Capital freedom is sold as the purest form of economic liberty. Money moves where it wants, investors choose winners, and markets discipline bad decisions. That's the promise. But here's the mystery. If capital freedom really works, why does it always end the same way with restrictions, controls, and emergency rules? Why does every system that removes limits on money eventually rush to put them back? The answer isn't ideological. It's mechanical. And once you see it, the pattern becomes impossible to ignore. For centuries, money moved slowly. Capital was tied to land, factories, ships, and people. Distance, time, and friction acted as natural stabilizers. Financial crises happened, but they spread at the speed of horses and ships, not algorithms. As finance modernized, thinkers like Adam Smith praised the efficiency of free capital, believing rational actors would allocate resources wisely. But what early theory underestimated was scale and speed. Once money could move instantly, the system changed. What looked like freedom began to resemble volatility. In the late 19th century, under the gold standard, capital flows expanded rapidly, but gold imposed discipline. Countries couldn't create unlimited money, and capital flight had consequences. When imbalances grew, recessions followed, painful but contained. The real experiment began after gold's constraints weakened. Governments gained the ability to issue debt and currency freely, while capital markets globalized. Money could enter and exit countries faster than governments could respond. Freedom had outpaced control. By the late 20th century, financial liberalization became doctrine. Capital controls were dismantled. Borders opened, investment surged. Growth followed. But the success hit a flaw. Capital doesn't just chase opportunity, it chases momentum. Booms attract inflows. Inflows inflate bubbles. Bubbles create false stability. The system rewards speed, not patience. And when sentiment shifts, it shifts instantly. The breaking point always arrives quietly. A currency weakens, a bank fails, a rumor spreads. Capital exits faster than it entered. Entire economies can collapse in weeks. Exchange rates spiral. Credit evaporates. Governments face a choice: allow collapse or intervene, and they always intervene. Controls are imposed. Withdrawals are limited. Transfers are delayed. Markets are paused. Capital freedom ends the moment it threatens systemic survival. The fallout is never evenly distributed. Those closest to capital exit early. Workers, savers, and small businesses absorb the damage. Trust erodes not just in markets, but in institutions. Ironically, the controls blamed for failure are often the only reason recovery happens at all. Once panic is contained, stability returns. Growth resumes. Then the cycle restarts. Freedom in good times. Control in bad times. Each crisis produces promises. Better regulation, smarter oversight, improved transparency. But none address the core problem: human behavior under uncertainty. Markets are not purely rational. Capital moves in herds. Fear overrides fundamentals. No reform removes that reality. So governments rely on the only tool that works when confidence collapses: control. Today, trillions move across borders daily. Algorithms react in microseconds. Digital assets bypass traditional safeguards. Yet the pattern hasn't changed. When stress hits, platforms freeze withdrawals. Central banks intervene. Governments rewrite rules overnight. Capital freedom survives only until it matters most. First, capital freedom creates efficiency, but also fragility. Second, financial control isn't ideological, it's defensive. Third, every system eventually chooses stability over purity. The open question isn't whether control will return, but how extreme it will need to be next time. As capital moves faster and trust becomes more fragile, the margin for error shrinks. If you want to understand the forces shaping money, power, and financial freedom, subscribe, stay curious, and keep questioning the systems that only reveal their rules during crisis.